Hey guys, Omar Khan here from Theta Trading. I want to talk to you today about something that's probably not talked about enough, which is what do we do? How do we invest? What are good strategies? What are bad strategies? I want to go over a couple strategies that may be a bit misunderstood. First one being the credit spread. Okay, so now when you open up the world of options, you can pretty much do any different strategy in various combinations. But today we're going to focus specifically on credit spreads. We're talking about the pros and the cons, okay? Now, a credit spread is this. Now, normally when you sell a put or sell a call, it's a pretty simple transaction. So, for example, what we do here at Theta is we sell puts on high-quality companies that we don't mind owning, which is great. So our default position, as long as we're not borrowing money, is, well, we'll have to own a stock as a worst-case scenario, in a company that we wanted to own anyway. So we're fine with that. No problem there, okay? So now what a credit spread is it's a bit different, okay? So let's say, for example, I wanted to buy 100 shares of Apple. And Apple today is currently trading at 120 bucks roughly, okay? Well, I can say to myself, I can write 115 put. I can get paid, let's say, $3. I can take that. That's a pretty good deal because I want to buy more Apple. So that's one way of entering the market. I can write an Apple put or sell an Apple put. The word write and sell are synonymous. So I can sell an Apple put at 120. Or I can sell one at 115. I can, it's really my choice in terms of how aggressive I want to be. Now, what exactly is a credit spread? Well, let's take a look at what a credit spread is. Well, credit spread is meant to be cash settled. So when we write a put, our default or our worst case scenario is that we own a high quality stock that we wanted to own anyways, which is great, right? Like, for example, if I were to write a put or sell a put on Apple, things don't go my way because that happens frequently. Right? When you're in the world of trading, there are ups and downs in the stock market. Things don't go your way sometimes. That's fine. Now, the cool thing with writing a put, in my opinion, is that, if I sell a put, and let's say I get paid a few bucks, which is a substantial return for that month, so I get paid 2, 3, 4% simply for agreeing to buy a stock I wanted to buy anyways. And if things don't go my way, well, I have to buy that stock. No problem there. Okay. Now, what exactly is a credit spread? How does that work? Okay. Well, a credit spread is this. A credit spread is when you sell a put or sell a call, let's say, for example, and then you simultaneously. So on this particular example, we're going to go with a put, okay? So let's say, for example, Apple is trading at 120, okay? And I sell an Apple 110 put, okay? And then I buy an Apple 105 put. That's an example of a credit spread. Now, the concept is that I'm supposed to get a lot more money on the put that I've sold than what I'm paying. But there's not a huge difference. There could be, depending on the stock and the time frame and all that stuff. But what happens is you have to write a lot more options, a lot more contracts in order to make it worth your while. So, for example, if I were to write a put on Apple at stocks at 120, and I were to write a put at 115. Well, let's say I got paid $3. Great. Okay. Now, if I'm doing a spread, well, let's say I write the Apple 115 and buy the 110s. Well, let's say my credit, let's say I get paid $3 and I have to pay $2.50 for the puts that I'm buying. Well, my only credit that I'm receiving is 50 cents. Okay. But the cool thing is there is $5 that I'm exposing myself to. Okay. So I'm writing a put and I'm simultaneously buying a put. So my responsibility is the number in between, the number between 115 and 110. Now, the reason we don't like doing credit spreads is there's a few different reasons, okay? A, they can become extraordinarily stressful. For any of you guys who have done credit spreads, especially on stocks that you don't even necessarily even know or like or whatever, that can be even worse. So, for example, if I'm getting 50 cents on a credit spread, well, I would have to do 6 times as many to get that same $3 that I would get on the naked put, which is doing what to me? It's giving me a far greater exposure. So I have to do a lot of contracts in order to generate the same absolute dollar figure, right? And that to me is a high level risk. Warren Buffett has 2 rules to investing, and they are quite simple. Rule number 1, don't lose your money. Rule number 2, don't forget rule number 1. Now, let me ask you a question. If the greatest investor of all time is adhering to a strategy where he's super disciplined about protecting his capital, why would I try to reinvent the wheel and try to circumvent that process, which has worked extremely well for him? Okay. Now, someone asked Warren Buffett years and years ago, "Hey, Warren, how come more people don't want to invest like you?" And he said a very simple thing. He's like, "Well, most people are not interested in getting rich slowly. I don't consider it all that slowly. I consider it methodically. predictable over a period of time. Now, when you're doing credit spreads and the market retreats the way it has the last few weeks, well, what can happen is it can trade through your spread, right? And that means you are going to have a permanent loss of capital, right? And that's okay. If you're fine with that, if you're okay with that, you can make a far greater return, no doubt about it, right? But there's two things you have to be wary of, okay? One is the potential to lose a large sum of money. So, for example, a few weeks ago, Apple was trading at 140, okay? And let's say I said to myself, you know what? There's no way Apple's going to 125. Can't happen, right? It's a big drop. And I wrote the 125, 120 spread, and let's say I got paid 50, 60, 70 cents, whatever it may be. Okay, but remember, I'm exposing myself to $5 risk in between too. And Apple did what it did. It went from 140 right down to 120. Well, I'm in deep trouble here. In fact, I'm in deep shit, right? And I don't like being in deep shit. This causes sleepless nights. This causes worry. It causes anxiety. Stress levels go up to the roof. I have been there, done that. I have literally traded tens of thousands of contracts of credit spread. Now, again, for those people who are okay with that level of risk and are willing to sit at their desk or their phone and monitor this all day long, that's fine. Now, some people say, well, I don't have to monitor. I just put a stop loss on this thing. Okay, that's fine. Now, what are you going to do with the stop loss when the stock gaps down the next day by $5, right? Which means, let's say, for example, one day Apple closed at 125, and you're like, okay, well, it hasn't really hit my spread. I don't have to worry about anything. The next day, some bad news comes out and it opens up at 120. Your stop loss is useless. It was not able to be executed. So now you're exposed to a full maximum loss of $5 a share. And because you had to do so many contracts in order to generate your real capital, you've got a lot of exposure there. So there's a great likelihood, a very high likelihood, during pullbacks like this, you're going to lose a large sum of capital, okay? Now, that's fine. If you're okay with that level of risk and you're willing to monitor all day long, that's fine, right? That is not what we like to do here at Theta. It's not what I like to do. I want to be in and out in 30 minutes, and I want to know that my worst case scenario is that I own Apple, right? Because I don't like to lose money. I don't want to have a permanent loss of capital, as Warren Buffett says, because it's, again, if the greatest investor in the world is trying his best to avoid permanent loss of capital, I would be an idiot not to follow that rule, right? There's a famous saying that goes, wise people learn from other people's mistakes, fools learn from their own mistakes, right? So I'm saying here, don't be a fool. Unless it's something, again, you're okay with. It's fine if you're okay with it, you're willing to accept the level of risk that comes with it, and you're like, you know what, I'm totally fine with it. That's a different story. But if you are not fine with it, if you're like, you know what, I don't want to spend all day long trading, because the vast majority of people who are investing and want to manage their own money, they've got a 9-to-5, or they've got a business, they've got a busy family life, they don't have time for this, right? So when you write a put on a high quality stock you want to own, well, as long as you're not leveraging or borrowing money, your worst case scenario. Your worst case scenario is that you're stuck with stock. And stock too, that in a company that you're more than happy to own at a discounted price, and you got paid a decent amount of money for it, right? Now, if you own that stock, you have a lot of choices from there. You can write a covered call. You can wait for it to appreciate back up to where it was, right? You can collect a dividend in the case of Apple, or most other, like a lot of other stocks that we trade. So it really boils down to, what your preference is and what your level of tolerance for risk is. For us, we don't violate that rule from Warren Buffett, that first rule of investing, which is not to lose our capital. And that's why I don't do credit spreads. Now, I'll tell you a personal story of why the last time I did credit spreads. So 2010, I happened to be on Wall Street that day. Now, I live in Toronto, Canada. I happened to be on Wall Street that day. All right. So I'm on Wall Street that day just randomly. We were there for an event. So I'm on Wall Street, and credit spreads are way out of the money. And I mean way out of the money, way out of the money. They're like, 10% away. So I'm not got no problem here. And that was just after the financial collapse of 2008, 2009. The markets were more than recovering. They hit their bottom in March of 2009, and they had recovered significantly by 2010. So what happened was flash crash. To this day, I really don't know why it happened, but the market retreated 10% roughly in the course of about an hour, and I had no time to react. So it traded through all of my spreads, okay? And it terrified me. Why? Because on paper, I had lost $400,000. Now, 11 years ago, that was a lot of money for me. It caused stress. It caused anxiety. I wasn't sleeping well that night. And I said to myself, never again am I going to put myself in this position. And I haven't since then, right? Now, luckily, the next day I only lost about 110 because the market had opened up and done well. But that was a very, very expensive lesson to learn. And when you're self-taught the way myself and we are at Theta, you learn a lot of valuable, expensive lessons along the way. And the reason we don't do them is quite simple. It is because it has the potential for a permanent loss of capital. So here at Theta, we trade to invest. We are not your traditional traders. We always make it so our default position, as long as you're not borrowing money or leveraging, is that we own a high quality company that we don't mind owning anyway. So for example, Apple's trading at 120 today. I agree to buy Apple. I say, you know what? A month from now, I'm going to buy Apple for 115. Great. Someone's going to pay me $3. Only one of two things can happen. Either Apple will go below 115 and I'll have to buy it, or it won't. It'll stay above 115. Either way, I keep that $3. So for me, that is a win-win every single time. It keeps the anxiety level down. You're able to sleep all night. There's not a lot of monitoring required. You've done your fundamental homework on Apple. You believe in a long-term trajectory. And that's the cool thing about only doing this on high-quality stocks that you truly believe in. Well, if Apple temporarily happens to go down and I had to buy it, I don't view that as a moment of fear or time of fear. I view that as a time of opportunity, right? I look at it and say the best stocks, the best companies in the world that I want to own are on sale right now. That will only come when you psychologically, when you fundamentally in your mind say, I know what this company is worth. I believe in this company. I know where it's headed. So when it retreats in price, and the market does every so often, in fact, once a year, the market can be expected to retreat at least 10%. Once every 5 years, 20%. And once every 10 years, 30% or greater. Now, you know this is coming. You know it's coming. There's no getting around this, right? It's historically accurate. It doesn't necessarily mean it'll happen guaranteed in the future, but if history is an indicator, high likelihood of it happening. Now, if I know that, and the markets pull back every so often, and I believe in my companies, I think they're going to be worth a lot more than they are today. When the market pulls back, am I going to be fearful? I'm going to be like, oh my God, what do I do? No. I'm going to be like, now is the time to load up, okay? That's not meant to be advice. That's a general rule of thumb. That's the way we think. Now, but when you do credit spreads and the market pulls back and you're too far exposed, well, you could lose a substantial sum of money, right? If you've got 50% of your portfolio in spreads and you have a pullback like we had last week, you're in deep, deep shit, like I said. And who wants to be in a big, giant pile of shit, right? Nobody, right? Want to sleep all night, want to have a good time, want to relax, want to spend, our mind, have our mind be basically unencumbered of stress. Because when you're in a stressful environment, you don't think well. You don't make rational, logical decisions. Everything becomes more difficult. So we have a very strict framework of investing here at Theta. We strictly stay away from credit spreads for the reasons I've outlined. And that's exactly why we write naked puts and covered calls. More so naked puts, but the basic tenet is simple. We simply agree to buy high quality stocks that we don't mind owning anyways, and we write puts on them, which means we get paid a lot of money simply for agreeing to buy these companies and stocks. Not for actually buying them, simply for agreeing to buy them. Now ask yourself, what side of the coin do you want to be on, right? One side you have credit spreads, yes, you can make more money, okay? You can, no doubt. But it'll put you through the ringer, okay? You're going to go through a lot of stress, and at times it is absolutely going to terrify you, okay? That's one strategy. And you have to spend a lot more time. You have to be willing to do that, and you have to be willing to say, okay, I'm okay losing a substantial sum of money if that happens. The other hand, I say to myself, I can just agree to buy companies that I want to buy anyways. And the worst case scenario for me is that I own one or more of those companies. And that happened last year during the COVID crash. It happened again just now during the mini pullback we're having. It happens frequently. But the reason we prefer this system is because when the markets pull back, we believe the markets will. We believe in human ingenuity. So we believe that the markets will eventually recover. And when you're just holding high quality stock, you can wait it out. You can write covered calls. You can collect dividends. It is a very forgiving system, and you can make a substantial rate of return. Another saying by a famous saying in the finance industry: bulls make money, bears make money, pigs they get slaughtered. So we like not to be pigs. And again, I want to preface this by saying it's okay. If you want to do this, just understand the risks that come along with it and be okay with that level of risk. If you're not, to me, the litmus test to all investing is, if my investing causes me to be sleepless at night, tossing and turning, that means it's simply too much. It's too high of a level of risk. And that is why we don't do it, okay? So that's a lesson on credit spreads, my own personal story, why we don't do them here at Theta. Now, I've been trading for 23 years. I learned a lot of valuable lessons along the way, and some have been very, very painful, like my credit spreads lesson. And there's a simple reason we don't do it anymore. I can make fantastic money not having to do that, and I'm simply not comfortable with the level of risk. Anyways, look forward to seeing you guys sometime soon, and please make sure you like, subscribe, and follow us here at Theta Trading. Take care, guys. We'll talk soon.